Yes, it's really important to understand that the inflationary pressures that are going to come through from ESG have really got to be recognised across a broad range of industries. So historically, businesses and governments have really taken the environment as a free good, and now companies are really having to reinvest to change their operations, to clean up pollution and to drive returns. Let's just look across a range of industries to start with. So the power generation sector right through to transport and cement and steel manufacturing. Starting at the bottom end of that list, if we look today and really costed greenhouse gases as a proportion of the profits of the cement and steel industries, we'd see that we'd almost take up 100% of the profits of those businesses if it were fully costed. So those industries are starting to reinvest to really change the processes that they're using so that they can be more sustainable in future. I think that's going to lead to higher prices and an inflationary pressure in the short term. In the longer term, however, I think the energy production is going to be a really key focus for investors. Let me just rewind a few years. So pretty much for the last decade, we've seen rising energy prices. They've been driven by the additional subsidies that have been put on electricity to allow companies to invest in renewable energy. Lazard's been doing a study for the last 15 years looking at the cost of energy. And their study shows, or our study shows, the fact that in 2018, for the very first time, we saw renewable energy be cost competitive against fossil fuel production, fossil fuel driven energy. And what that means is that in the longer term, we will actually start to see that lower incremental costs from renewable energy then bring this inflation curve back down again to a point where, in the long term, ESG is likely to lead to lower costs for consumers.
Jeremy, this is fascinating because potentially then we could see a policy mistake, because what you're saying is we've got this pricing pressure. We know out in the marketplace that transitory prices, if they stick around for a lot longer, is very challenging for central banks, and therefore there's pressure to tighten. But you need cheap money around if you want to see the level of investment in some of these renewable sectors. So any tightening could derail that and potentially lead to high prices for longer, right?
Yeah, but I think the key here is that this is just one of the pressures around inflation. So I wouldn't set the entire government inflationary targets based on what's happening in the renewable space or what's happening from this pressure as a move to ESG. What I think is important is that investors can really play a key part in understanding how companies transition to a more sustainable future. It would be my focus in 2022 that investors really look at the capital programs that companies are putting in place, because it's really that incremental capex that's being invested and the return that's required on that capex which is going to lead to the trajectory of earnings for companies over the medium term. And that's a real focus of our research at Lazard.
Well, that's fascinating. So give us a snapshot of your current insight based on the research you've done here, because I think our investing audience has been trying to draw its own conclusions for a while here as to who is actually going to pay this extra cost. Will it be the shareholders or will it be the customers ultimately? I presume the answer is a bit of both, depending on the sectors.
Yeah, and it always comes down to, where companies can retain pricing power and where they really have to, take that additional cost on, and they're in much more competitive industries. And I wouldn't want to draw a single conclusion across all industries. There will be winners and losers from this. But if you look at this energy transition as it runs through different industries, you'll see really new investment opportunities. Look at the shift around electric vehicles. That's going to impact the entire supply chain right through to semis. Look at the changes that are required in the grid, the electricity grid. That actually goes right through to the components that ABB produce and Siemens. So there's a wide range of outcomes for different companies. What you really need do here is be incredibly selective about the securities you're picking out, and really think about how this shift towards a sustainable society is likely to drive the capex plans of the companies and the return profile they can generate as a result.